Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
Tonight, Russian troops are entering the Ukrainian capital city of Kiev. And are we in the crosshairs of cyber attacks? We'll have that and more on this Friday, February the 25th, 2022. Hi, and welcome to Wall Street Wrap-Up. I'm Andre Laborde. Hope your week went well. Well, last week, we had a conversation with Major General James Livingston, recipient of the Medal of Honor, about the events that possibly could be occurring with Russia's buildup of troops on the Ukrainian border. We discussed how we thought Vladimir Putin of Russia would probably not do anything while the Beijing Olympics were going on because he didn't want to anger his fellow communist Xi Jinping. But General Livingston said once the Olympics would be over, then all bets would be off. Well, the Olympics ended on Sunday, and by Wednesday, just 3 days later, Vladimir Putin launched the largest invasion on another European country since World War II, over 70 years. Now, we'll have more of this in a moment, but coming up tonight, we'll have a guest who's been in the financial business for many years, Michael Farr. Michael is the founder and the president of Farr, Miller in Washington. He's a CNBC contributor, and many of you who used to watch Louis Rukeyser on this station on Friday evenings or Nightly Business Report, well, he was a regular guest as well. But first, it was just 1 year ago the United States was energy independent. Today we are dependent on OPEC and on Russian oil. Russia produces approximately 10.1 million barrels of oil every day. Now, this is about $1 billion daily to the Russian economy and to the Russian treasury. Now, the United States purchases between 5 and 10 million barrels of oil per month from Russia. 1 year ago, we were producing more oil and gas, so much so that we were exporting it for the first time in many years. But the Biden administration has now restricted no new oil leases on federal lands. They have increased restrictions on existing federal oil leases, and they're pressured banks, major banks, from making loans to oil and gas exploration companies so they're doing more exploration. The administration then closed the Keystone XL pipeline. Now, this pipeline produces about 830,000 barrels of oil every day. Now, just as Europe is dependent on Russian oil and gas, now so are we. And it's very dangerous for the United States to be so Russian dependent. Now, how did the markets do this week? Well, the Russian-Ukrainian tension sent stocks on a roller coaster ride this week, but the week ended well, and it ended in the green. The S&P as well as the NASDAQ posted weekly gains. The week of the Dow Jones ended at 34,058. Now, that was down almost 0.5% for the week. The S&P 500 closed at 4,384, and that was up 1% for the week, and it was the Dow's best of 2022. And analyst Brian Nagel of Oppenheimer Securities has put Home Depot as a buy with a higher price target at $470 a share. Well, let's get to our guest this evening. Michael Farr is, well, he's no stranger to the investment world. He's a CNBC contributor, and he's founder and president of Farr, Miller in Washington Investments with over $2 billion of assets under management. And best of all, he's here with us tonight. Hi, Michael. Welcome to Wall Street Wrap-Up.
Thank you so much. It's wonderful to be with you.
With all the events that are occurring right now, what do you think is the most important that's weighing on the stock market?
You know, that's like saying we've got 6 rooms in the house on fire. Which one's the most important? You know, I think what we have is we've been coming into the year with a repricing of 2 significant events. Markets are trying to price for a tightening in monetary and fiscal supply. Monetary and fiscal policy are tightening. This is the first time in a lot of years, really going back to 2007, 8, 2009, where the Federal Reserve is genuinely tightening policy, fiscal policy tightening. So markets need to reprice. That's number one. Number two, we've been repricing for this emergence from pandemic to endemic. How do we go from global pandemic, shutdown, masks, everybody knows the drill, to this new age where we're reopening and we're going to get everything moving again. And perhaps also free up the supply chain. And now, third, we're trying to suddenly reprice for a real military conflict that could indeed be a war in Eastern Europe that's going to involve Western Europe. That's a big deal. So there's a lot of volatility now as markets try to set the right price and the right level.
Do you think COVID is now gone?
Markets can learn to price some of the most dire, kind of awful things we go through. I mean, we've seen markets figure out what to do with acts of terrorism, as awful as that is to say. At 9/11, you saw markets react. When you got a couple of years ago to the Paris bombings and other attacks, markets don't react because it doesn't change. So far, none of these attacks change the map. We've seen what the pandemic can do globally to shut down commerce. Now we seem to be emerging into a milder form of COVID. If indeed this virus follows the trends of other viruses, and this is what Wall Street does, we price these sort of expectations. So if it follows the trends of other viruses and it does become, could be more contagious, but more mild, such that we don't have to shut down the economy, we don't have to shut down office places, workplaces, commerce and retail and everything else, then yes, I think we know how to price that, and we're going to move on. So to that extent, sorry for the long answer, I think it's largely beginning to move into the rearview mirror.
Coming up next month, the Federal Reserve is going to be meeting to whether or not to raise interest rates, and it's almost a certainty, I guess, of not just raising, they will be raising rates, but from what I understand is that the market is already basing in 25 basis points. That I think what may shock the market if it's 50 basis points. First off, do you think that 25 is already based in the market? And what are your thoughts? Are they going to do 0.25%? You think they're going to do a half, 50 basis points?
I think that a series of raises are already baked in. I think that the first one is likely to be 25 basis points. And you say likely because you don't know what the Fed was going to do. And you're judging Jay Powell's personality in many ways. He has been very deliberate. He's been very data dependent. He has been very dovish for the large part of his career, and he doesn't want to make a mistake. The risks of a Fed policy error are exceptionally high, that they will go too far and mess this up. Now, you've heard the calls from B of A and Goldman Sachs and others looking for 7 hikes this year. I don't see it. I do think that we're already seeing economic headwinds in place in several different areas, and I'm calling for 3 to 4 hikes this year. We'll see if that's right.
Do you think they waited too long in starting to raise rates? Right.
Yes.
What about, well, that was that was a good one. Well, now what about they're still buying bonds, aren't they? What, 115 billion to 120 billion, or have they started to cut those back?
Isn't that marvelous? I mean, where everybody's concerned about how the Fed's going to go and attack high interest rates, and they're still out there buying bonds. I mean, not only are they trying to stop these purchases here in March, they're going to go ahead and increase rates in March. All the while, for the bonds that mature in their $8 trillion portfolio, they're continuing to reinvest those. So there's already a whole lot of purchasing that the Fed's going to continue to do. It's just not going to be as much as it was for the past few months.
I guess it's a lot like being on a diet and having cheesecake for dessert. You know, you're saying you're gonna.
Yeah, we're gonna keep throwing gasoline on this fire, but not quite as much. So how about that? Is that a good place to kind of slow things down to take the heat off? I guess.
Your clients, so are you advising them to go into more? Well, right now with sell-offs the way they have, I mean, tech these days are getting to be very good buys, although with raising of interest rates, that usually gets hit first. Although you've got consumer staples, you've got many different sectors. How are you advising your clients?
You know, one of the difficult things that you really can't do as a portfolio manager is change midstream, to start moving your portfolio around based on the latest headlines. So you have to have a portfolio that's invested both to endure the difficult times and to enjoy the good times. So I think you have to make sure that you've got a solid portfolio that's ready to do those things. I think clearly for us, a shift to value, a shift to those more defensive names during a rate tightening cycle makes most sense. So some of the value names, of course, companies with solid balance sheets, companies increasing their earnings, companies that don't have too much debt, consumer staples. I continue to like the consumer staples. I like the healthcare stocks. I continue to like a lot of the large tech, but companies with earnings and balance sheets. The names that you talked about that get hit are those names that are selling on sales data and not earnings data and number of website visits and all of these other things that don't put cash in your pocket. If there's not putting cash in the company's pocket, forget about it when things get tough.
Let's say if you're already in tech or stocks that may be a little more volatile when it comes to rising interest rates or geopolitical events that are occurring on. When they drop, is it a good time to buy more?
Yeah, it may be. I had a great friend, my partner, John Washington, who used to say the best time to buy stocks is when you have money, and the best time to sell stocks is when you need money. And otherwise, you just own stocks. And it sounds like one of those wonderful patrician, old money kind of pieces of advice, but there's a lot of wisdom in it. You'll drive yourself crazy trying to time markets, and it won't work. So yes, if you have some cash set aside and you can buy some really good companies with strong earnings and strong products and strong management teams when their prices are down, absolutely do it. But you do it, I hope, with your eye on the next 5 to 10 years. Our average turnover is about 15% a year. I'll hold a stock for 6 years easily. I think I've probably owned Johnson and Johnson for, I don't know, 25 years in my own portfolio. 30? I don't know.
One of my favorites is Bernard Baruch. Always buy when there's blood in the streets.
Yes, and Benjamin Graham said you make your money in bear markets. Make your money in bear markets. Benjamin Graham, he had another line that said, the older I get and the longer I do this, the less I know what the market's going to do in the short term, but the more I know what investors should be doing at all times. And I think I feel that way more with all this white hair that I now have found has somehow snuck its way onto my head. That I know what investors should be doing, and investors shouldn't be jumping around. Investors should have a clear set of portfolio goals, a clear philosophy that's well articulated, and stick to it doggedly and dispassionately.
When it comes to inflation that's right now going around the United States, do you think it's going to get worse before it gets better? Or do you think that we've seeing right now at, what is it, about 7% from last year? Do you think this is the worst it's going to get?
I think the rate of inflation is probably as bad as it's going to get. I think this 7% rate of increase is probably as bad. Could it increase from here further? Yes. Will it increase more slowly? I think it will increase more slowly. I think that there are a lot of structural headwinds that we're coming towards here in the economy. There's a fiscal cliff that we're approaching. The unemployment benefits are going away. Those $600 every 2-week checks, they stop. We know that the suspension of student loan payments is stopping. Anecdotally, I talked to a physical therapist, young physical therapist, doctor in physical therapy, said that he's going to have to start paying $600 a month in student loan payments. He hadn't paid them for a couple of years. $600 a month is a lot of money if you haven't been paying it. That takes money out of the system. So they're not going to be more checks. People are going to have higher bills. People are paying more because things at the supermarket and the gas pump are more expensive. Rents are going up. So all of these things tend to tap cash flow, and therefore people don't have as much money to drive prices higher, and inflation starts to take care of itself a bit.
Michael, that's a really good point. So if, such as like the analogy that your friend who's having to take money out of his other disposable income now to pay on student loans, gasoline, rent, and the necessities of life. So this will take away from purchasing of other things. Do you think this will then slow down the economy?
I think your question's a perfect question. Yes, that's what I mean. These are economic headwinds. The government created a bunch of economic tailwinds, and now as they get removed, we have these economic headwinds. So it's because of those headwinds. Now we can add the addition of a slowing economy, perhaps in Western Europe. And when you see a trading partner the size of Western Europe start to have difficulties, that's going to affect all of its trading partners, either in China, Japan, the US, Canada, Mexico. So these other headwinds are in place to already slow the economy. I think that the Fed, therefore, doesn't need to think about 7 rate hikes. I think the Fed can be data dependent as they have been. And I think probably 3 hikes, maybe 4 is all we need to see to make sure that inflation doesn't take off. And yet, we don't want to kill the golden goose. We don't want to kill this growing economy. I mean, we've got this problem because the economy's good right now.
Michael, isn't it interesting where the Federal Reserve wants to slow things down, like pull on the reins of the horse, because they want to raise interest rates because they don't want to fuel the economy too much. But by pulling on the reins, they are slowing down the economy, which is also then causing a decrease of inflation. But then at the same time, it's, as you were just saying, slowing the economy.
You know, interesting for me in the last release of the Fed's minutes, and I promise I won't get too wonky here, but they said that they said we have now achieved maximum employment. Maximum employment. They had said before they were approaching maximum employment. The Fed only has 2 mandates. One is price stability. The other is maximum employment. So they're at maximum employment. That means probably they don't expect a whole lot more people returning to the workforce. That goes to wage pressures, and we're seeing wage inflation. You have to pay more for employees. And that's a good thing for the average American. The problem so far has been that the wages haven't been going up as fast as prices at the supermarket. But from the Fed's perspective, how do they keep those prices from surging in some sort of runaway way? And the way they do that is to increase interest rates and basically make money a little more expensive.
If you're just joining us, we're so happy to have Michael Farr. But don't go away, because we'll be right back. We're talking with Michael Farr from Farr, Miller & Washington and Hightower Investors. I remember the days of when Paul Volcker had to break the back of inflation he had to raise interest rates so much. But by doing so, it also caused a recession. Do you think that by them raising rates, and also what you were talking about right before we went to a break, they're having to do the 3, 4, maybe 5 rate hikes, do you think that's enough that will not cause a recession, but also break the back of this inflation?
So many of these tightening periods for the Federal Reserve have led to recession that I think it's probably likely that at some point we will have some sort of a recession as a result of this Fed tightening period. So the odds that they will err are high.
We talk about black swans. These are unknown events that occur that will affect the stock market. Well, now that we know that Vladimir Putin is on the borders of Russia, on the borders of Ukraine, and wanting to take that country over, I don't know if that's already been somewhat baked in, but you've also got, I'm sure, China's Xi Jinping, and I know he's salivating over Taiwan. These type of black swans do you think that may be affecting the market later? I mean, first off, do you think Ukraine is already baked into the market, or do you think we have more pain to come even on that aspect?
Yeah, I certainly think there's more pain to come from Ukraine. I think that Vladimir Putin really doesn't know yet what the calculus is going to be, how much these sanctions are really going to hurt, how severe they're going to be. Germany coming out and saying that they're going to not support the pipeline. That was very important today. Boris Johnson saying the same thing for other sanctions in the UK, President Biden saying that sanctions are going to hold. So I don't think a full invasion is priced in, and the aftermath of the invasion, because you've got steps 1 and 2. Step 1, okay, can Putin go into Ukraine and take Ukraine? All the military folks say yes. He's going to get through there like a knife through butter, 5-6 days. He's in Kyiv. Great. Then what does he do? He has sanctions, he has guerrilla fighting, he has loss of life, he has financial sanctions against the oligarchs who are not going to be happy with him. He has a very difficult path out of this, so we hope he negotiates. But as black swans go, we certainly didn't see the pandemic coming. The thing about a black swan is you really don't see it coming. But there are plenty of black swan potentials coming from China and other places around the globe. Markets will adjust. We even adjust to recessions. Recessions are normal. We live through these things. They're not any fun, but we get through, and corporate America survives. And those holders of Johnson & Johnson and Pepsi-Cola and Microsoft all seem to have more money, 10 years into the future than they do today, even after they've gone through recessions.
It's interesting. It's a very good point, Michael, because I love history. And I know reading with the Cuban Missile Crisis of October of '62, I think the Dow Jones had dropped something like 6 or 7%, and the S&P 500 had dropped about 22 to 22.5%. But after the crisis was over, the market went right back. And even on September the 11th of 2001, it only took a few months before the market was right back again. So for geopolitical events that occur, that there's usually not that long of a period. Of course, it hurts during that month or so, but looking at it in a rearview mirror, it's not as bad.
They snap back very quickly. And, we often we guess wrong, too. All of the calculations, I remember back, certainly 9/11, and post 9/11, as George W. Bush was talking about attacking Iraq and going into Desert Storm 2, and started telling us that it was going to be in January, February the next year. And we got ready, and we started calculating the hundreds of billions of dollars it was going to cost. And we started doing the math. Once that attack started and everybody was expecting markets to fall dramatically, markets went straight up. The pricing in had been done, and we got it wrong. And, we had an additional bonus there. When you think back at that footage, for those of you who weren't around, that was a televised war. We'd never seen anything like this before. And we saw the bombs dropping in Baghdad, and we saw the bombs dropping throughout Iraq. And our troops were well at a great distance, and there were not huge loss of life in that particular conflict. And it looked like, well, wow, we're very powerful. We can go in and we're not going to have the consequences. We don't know if it'll be the same this time, and we certainly hope that there will be very little loss of life, and we hope there'll be very few American lives lost in this particular conflict. I hope desperately that President Putin will listen to reason here. I don't see a big upside for him if he carries this out and goes into Kyiv.
Sure. Do you think financial sanctions will have the effect? And the reason I ask this, Michael, is because where the United States is operating in a financial deficit because of the oil income that Russia has, they've actually got a financial surplus. And so I'm just curious, what are your thoughts?
The finances seem to matter not as much to these leaders like Putin and like Xi Jinping right now when they are in pursuit of an ideological goal. I mean, Ping shut down Taiwan. Ping has President Xi has shut down Taiwan, has shut down a lot of their tech industry. Jack Ma is, disappeared, is in his vacation home somewhere, we hope, okay. But, it's more economy be damned. I'm going to pursue my list of goals and interests. It certainly seems that President Putin is doing the same thing. Sooner or later, that weak economy at home will erode their base of support. Will it be sufficient to shake that support base for President Xi or President Putin? Time will tell.
Michael, I've got time for just one more question this time, but I certainly hope you come back. Michael, what's the best investment advice were you ever given?
Mm. The best investment advice I was ever given was to buy really good stuff and hold it a really long time. One older investor told me, "You want to do well at this? Never sell anything."
I think that person who told you is very wise. Michael, I hope this won't be the last. I hope you come back.
You're very kind to have me. Thank you.
Thanks a lot, Michael. Well, if you've got a question about finance or a comment about the show, we'd love to hear from you. Make it pithy, make it concise, and write us at andre@wallstreetwrapup.info. And now for a look ahead for next week. But first, what year was gasoline last below $2 a gallon? We'll have the answer in just a moment. Well, what year was gasoline last below $2 a gallon? It was in 2020. Now, in April and May of 2020 of that year, the average price per gallon nationwide was between $1.93 and $1.96. Today, it's $3.54 a gallon. Well, finally, we are in a stock market correction. A correction, now technically, is when the stock market is down 10% or more for this period, and which we are in now. When it's occurring, it is scary, but a little history is in order. Since 1980, approximately 40 years, there have been 33 corrections with the market dropping of at least 10% or more. In fact, the average correction drops over 18.5%. But now the good news, on average, the following year after a correction, the stock market rallies on average over 24.5%. Only 3 times in the last 40 years has the following year of a correction has the stock market been actually lower. So, while as history doesn't always repeat itself, it sure does rhyme. Now, world events are occurring so fast that it's affecting our economy. Now, in a couple of weeks, we're going to be talking with Ambassador Thomas Pickering. Ambassador Pickering was former ambassador of Russia, of El Salvador, and Israel, and he was also Undersecretary of State. He was appointed as ambassador to the United Nations, and former UN Ambassador Tom Pickering is going to be with us in a couple of weeks. And as you can tell, there's so much to discuss with Tom Pickering. Well, next week on Wall Street Wrap-Up, we're going to be talking with investigative business reporter Charlie Gasparino. Charlie is the business reporter for Fox Business and Fox News. Prior to that, he was also doing the same at CNBC. He's broken many business stories, and with juries finding Elizabeth Holmes guilty of fraud as the CEO of Theranos to the possible insider trading on Capitol Hill, Charlie, well, he's seen it all. He's also a columnist for the New York Post. From Fox Business, Charlie Gasparino, next week, right here on Wall Street Wrap-Up. Well, as a reminder, we do repeat the show on Sunday mornings, but always the best way is to set your DVR so you'll never miss an episode. And that's our show. For this Friday, February the 25th, 2022, I hope you've enjoyed it. My thanks to Michael Farr for joining us this evening. But as always, it's you. We appreciate you for allowing us into your homes tonight. Remember, you can always follow us on all the social media on Facebook and YouTube, Twitter, and WYES.org. So enjoy your weekend ahead and a productive week as well. I'll see you next week. For Wall Street Wrap-Up, I'm Andre Laborde. And remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.